In this video, we're going to be talking about a company that consistently raises the dividend every single quarter. And yes, you heard that right, every quarter, not just every year. It has a consistent history of growing revenue and earnings. We're talking about decades worth of consecutive earnings and revenue growth. And we're talking about a company that is being driven primarily because of some cost-cutting measures from Canadians, especially when we look to the fact that Canadians are absolutely tired of paying ridiculous banking fees. And we're also talking about a company that is witnessing a bit of a headwind over the last while here, which I'm going to get to in the bear case of this video. But the stock I'm going to be talking about today is Equitable Bank. This is one of Canada's main challenger banks, which is really breaking the status quo when it comes to what Canadians need to do in terms of banking. And it's really putting a ton of pressure on the big six in terms of overall performance, the mortgage rates they offer, the checking fees they offer, things like that. And I'm going to dive into the bull case, the bear case, and my overall thoughts on this company with the objective of getting it under 5 minutes. And as always, everybody drop a comment down below. Let me know what stock you want me to go over next, and grab some of those free resources in the description below that are going to help you become a better investor. They're absolutely free and they take just a couple of seconds to get a hold of. But let's dive right into the video. So what is Equitable Bank? They are the 7th largest Canadian bank in terms of assets under management. They started out as a very small bank, but have exploded in popularity over the last 5-year period. But overall, they aim to provide a very lean business model, no physical locations, and as such, they can provide a lot better accounts and products for Canadians who might be sick and tired of paying the sky-high fees that many of these brick-and-mortar big six banks do charge, or in the case of savings accounts, don't give you. So from that standpoint, I can jump right into the bull case, which is that growing angst among Canadians to be paying sky-high mortgage rates, sky-high checking account fees from the big six banks. When we go to Equitable, their interest rates are often cheaper on their mortgages, they're often cheaper on their HELOCs, and they offer very attractive rates in terms of their overall savings. Now, the other bull case here is valuation. Equitable Bank only trades at around 7.2x expected earnings. This is a PEG, price to earnings to growth ratio, of only 0.5, suggesting that the market really hasn't priced in a lot of Equitable Bank's forward earnings growth. When we look to expectations in terms of earnings, we're seeing $11 this year. It's going to dip a bit because of provisions, which I'll get to in the bear case. But then when we head forward, we're looking at 2026 of $12.69 and 2027 $14.56. This is double-digit growth rates. This is not a earnings growth rate that a big six bank would grow at. It's very difficult for them to grow at this rate. So the fact that Equitable is much smaller, more nimble, less overhead costs, should allow them to drive double-digit earnings growth in the future if provisions remain steady. So now I'll get into the bear case. We are starting to see signs of Equitable Bank slowing down a bit. So we have the orange line here, which is their total customers, and the blue line here, which is their year-over-year customer growth. We can see that it spiked in 2022 to 2023 and is now dipping quite a bit. Now, I had mentioned this about Equitable quite a few times. There was a very strong demand for its savings accounts, GICs, whatever that may be, during 2022, 2023, when interest rates were very high. People were able to get very high rates of return on their savings. Now that interest rates are coming down, their products are not necessarily, especially from a savings standpoint, as attractive anymore. And we're seeing that customer growth on a year-over-year basis slow down. Now, this is kind of the natural progression of the company as well. I mean, we look here, January 2024, 38.2% growth in year-over-year customers, whereas now we're sitting at 22.5. So there's a bit of headwinds here from overall growth, and we can also see this in overall deposits. Now, this is not only because interest rates are falling, but also just because of the tough environment Canadians are in from a cost of living basis. But we can see this chart here. The company's year-over-year growth in deposits skyrocketed in 2022. This was primarily because of an acquisition, but even previously, they were consistently able to grow deposits at a double-digit pace, and now we're seeing that slow to, a mid-single-digit pace. So we're seeing some slowing growth here, which is likely putting pressures on valuations as well. Now, the final bear case would be the state of the Canadian economy. Equitable Bank you would call it a B grade lender. It is not a prime lender like the big six banks. So provisions for credit losses are going to weigh on the company even more because the market could get fearful that there's going to be some sort of escalation that continues in the future. And if we look to their most recent quarter, the company reported a 77% increase in provisions for credit losses on a quarter-over-quarter basis. And this is what caused the company to have such a big dip in share price. Now, a lot of where the pressure is in cyclical indices like transportation, things like that, where the economic situation weighs heavily on them. So the market is likely a bit spooked here that provisions could continue to escalate. And this is definitely something you do need to keep an eye on. So overall, am I a fan of the company? Yes, I am a buyer of Equitable. I actually own Equitable. I have for quite some time. There is slowing growth here, yes, and I don't really think it's anything the bank has done overall. It's just a policy rate environment, and it is also the environment that, deposits are slowing because Canadians really don't have a lot of money to be stuffing into savings accounts right now because they're struggling so much from an economic standpoint. The only thing here is their loan book is more deposit heavy. It's more concentrated. It's not as high of quality as the big six banks. So valuations could remain lower in the future if the market doesn't really decide to reward this company with a higher valuation multiple. But overall, I'm a long-term buyer here. I think what this company is doing is very good, and I'm willing to hold this over the long term on the basis that more and more Canadians are going to shift to Equitable as they continue to offer better products, better savings rates, more attractive mortgages, more attractive HELOCs, things like that. So everybody, if you like the video, head down below, like, subscribe, comment, let me know what stock you want me to go over next. And as always, free resources in the description. They take just seconds. It includes some of my top 3 stocks from 2025, which are absolutely killing it this year. They're up around 21%, whereas the S&P is up only 2 or 3%. So head down below, grab that report, and stay tuned for more great investing content.